my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your daily technical analysis of foreign exchange markets. I'll start with Euro against the dollar. A reactionary bullish harami yesterday, if only just. But it seems the market is once again not too keen on testing down in this fairly free area we're actually in. Down to the upper trend line, currently at 102.01 of the September to date ascending wedge pattern. Overhead we still have the capping congestion between 103.38 to 103.69 and a descending long moving average just above that, currently at 103.86, which will probably enter the congestion early next week. We're also in between the upper time, currently 104.81, and the middle time, currently 101.10 of the broken but seemingly still influential January to May 2021 bearish Andrews pitchfork. This all highlighted once again the two recent core patterns here. We have a September to date ascending triangle and a September to date ascending wedge pattern, currently 98.93 to 102.01 for the latter. I've highlighted the ascending wedge pattern in blue to show you a clear idea of what I'm talking about. Both these patterns have had false breaks in both directions, which complicated things and compromised both patterns. However, both patterns also repaired themselves, and 2 weeks ago we saw a clear break above the upper trend line of the ascending wedge pattern. This left us with some topside opportunities. We have already seen the market reach and exceed the primary and secondary targets for the ascending triangle pattern, so these have been retired. We still have live the possible targets for the ascending wedge pattern of a primary target X2 in the 105.35 area and a secondary harder to reach target X3 in a 107.65 area. However, the peak of the market last week just short of the upper time, and without any closes over the declining long moving average at that time, even now, that's currently at 103.86, has raised some questions about the efficacy of both these bullish patterns, especially compared to the admittedly broken but still influential bearish Andrews pitchfork. Now, so far today, a push up into the overhead congestion band between 103.38 to 103.69, reaching the December 2016 low at 103.49, but then reverting back down. I suppose a not altogether unsurprising reaction right now, and looking like a possible shooting star pattern, maybe even a bearish gravestone doji at this moment. Cable, aka sterling against the US dollar. This is getting silly. We have a fifth countering pattern. Yes, a fifth, which is obviously indicative of intraday indecision. This time it was a fifth countering bullish harami, if only just, as prices once again did not like testing down to the upper trend line, currently at 118.35, of the recent ascending wedge pattern. Much as in Eurodollar, there are two core patterns here. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a late September to date ascending triangle, which has run its course, and also a September to date ascending wedge pattern, currently 114.95 to 118.35. Both patterns have been previously compromised and both have repaired themselves. Late 2 weeks ago there was a break higher over the flat trend line of the ascending triangle, giving possible targets for this pattern on the upside of a primary target X in the 120.20 area and a secondary harder to reach target X1 in the 122.5 area. Last week the market managed to reach the primary target X before pulling back. We'll see if there is still sufficient bullish incentive to reach up to target X1. Meanwhile, with the consecutive closes over the upper trend line of the ascending wedge pattern, I decided to lay out some possible upside targets for this pattern. Thus, a primary target X2 would be in the 124.20 area, with a secondary and hard to reach target X3 in the 128 even area. Of the remaining targets above, none seems easily doable right now, as we have the declining long moving average above, currently at 121.82, and the flatlining medium moving average below, currently at 116.36. So far today, a small move higher, staying clear of the upper trend line of the ascending wedge pattern and also the lesser Fibonacci line at 118.59. Next overhead we have the May 2020 low at 120.73, but just before then we have the previously reached target X at 120.20. Euro sterling. In the end, yesterday was an indecisive doji cross. Prices did follow on lower from the recent break below the highlighted roof pattern constructed over November, sometimes known as a half diamond pattern. They even approached the slowly rising medium moving average below, currently 86.15, but ultimately balked at testing it, pulling up and closing very close to the open. Thus, we still have the following potential targets on the downside for the roof pattern: a primary target X in the 86.02 zone, and secondary, harder to reach, actually much harder to reach if I'm honest, target X1 in the 85.45 zone. Interestingly, yesterday was also the third consecutive close below the broken but still repaired or seemingly repaired lower tine, currently at 87.14 of the April to August bullish Andrews pitchfork. I'm going to keep a close eye on this lower tine, as the earlier support from the lower tine, as I previously stated, was a more serious support, so such closes below as we've had are significant. I'd also like to point out that there is no finessing of this bullish Andrews pitchfork into a shallower bullish shift pitchfork. This is just not possible here. It was also the second consecutive close below the April 2020 low at 86.69, and we don't seemingly have much support below that until that flatlining medium moving average, currently 86.15, which interestingly sits just above target X. Now, so far today, a move back up, but seemingly in vain. As though prices moved above the April 2020 low, they faltered at the lesser Fibonacci line at 86.98, which is the base of the recent roof pattern, coming back down below yesterday's close, such we have a possible shooting star pattern right now. Indeed, looking at it right now, I have a suspicion we may turn this into a key reversal down, but whether it will manage to pierce the medium moving average, that's something else completely at the moment. US dollar against the Indian rupee. A second indecisive daily pattern yesterday, this time an indecisive doji cross. The base of the action was, more or less, the lesser Fibonacci line at 81.63, with a rising short medium moving average below, currently 81.53, in support. The top side was probably capped by the recent congestion at 81.94, though this wasn't actually tested yesterday. And also on a closing basis, we also had the declining short moving average, currently at 81.68, acting as a cap. Beyond that, the next congestion is a small band, 82.15 to 82.26. I'd now like to discuss the larger scenario, one which I'd often mentioned in my earlier commentary. So, I'd highlighted the September to early November expanding wedge pattern. You can see that in blue on my daily chart. Then late 3 weeks ago, prices pushed down through the lower trend line and carried on down until 2 weeks ago. This process confirmed that pattern and gave a primary target in the 80.90 zone and a secondary harder to reach target X1 in the 80.28 zone. 2 weeks ago, the market reached the primary target, but we've since seen the market fail to pierce down through the rising medium moving average below, and that's currently at 80.66. Such that I'm now wondering if perhaps, just perhaps, reaching the primary target may have been enough for this move. This requires a little more contemplation and some further data over the next few sessions. In the meantime, we have a fresh September to mid-November bullish Andrews pitchfork. The market is at the moment in between the lower tine, currently 81.11, and the middle tine above, currently at 83.16. So far today, an interesting and cautious attempt higher, based on yesterday's close and the short moving average, but not managing to reach this week's high, which was just short of the congestion at 81.94. US dollar against the Brazilian real. An interesting combination yesterday of an outside day and bullish harami. But the most interesting part was how the market closed right on the broken upper tine, currently at 535.86, of the possibly now self-repairing July to late August bearish shift pitchfork, after piercing up through it. This time the previous cap of the market, the lesser Fibonacci line at 538.13, did not manage to work, but the 50% Fibonacci line of the May 2020 to April 2022 move at 527.37 did manage to hold up prices. I personally continue to say this does not look that good as support, though the other slightly lower 50% Fibonacci line at 522.76 of the March 2021 to April 2022 move does look a better support. I suspect the strength of the latter may be due to the conglomeration of moving averages in between the two 50% Fibonacci lines, specifically the short moving average currently at 525.78, short medium moving average currently 525.19, and the medium moving average currently 524.47. Overall, the close right on the broken upper tine, despite the seemingly bullish outside day, seems to indicate that the bearish shift pitchfork may still be repairing the damage made last week and the previous week. 2 additional points. Firstly, we are set up to make a monthly key reversal for November. Thus, if we close on the 30th of November, EVO of 5 over 541.54 or under 517.91, then we'd be on. Right now, we're looking at the lesser cousin to the monthly key reversal, an outside month. Secondly, we had a golden cross late last week, if only just, of the short medium moving average up over the medium moving average, though I am not overly impressed by this one. US dollar against the Mexican peso. A very interesting bearish double yesterday that was capped, more or less, by the same combination cap as in the previous session, consisting of the declining short moving average, currently at 1949.47, the upper tine, currently 951.44 of the broken but still influential March to July bearish Andrews pitchfork, and finally the April 2022 low at 1971.68. Despite punching up through all of these, I would venture to say that they capped actually the top side. However, please note they are now rapidly separating away from each other, so their individual powers will be dissipating. I'm still mindful of how the broken upper tine is still seemingly driving the market lower. The base of the action was also the same as in the previous session, the May low at 1940.70. Overall, the recent moves lower all relate to the previously highlighted crossover combination in late October of the previously mentioned broken upper tine of the March to July bearish Andrews pitchfork and the middle tine, currently 1973.19 of the still intact bearish shift pitchfork for the same move. The question now is, what's next? As the base of the support crosses over the declining broken upper tine late next week. Now, so far today, a cautious start, the market in a narrow range and sitting on the 1940.70 base of action. Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.